Okay, capital budgeting. We know in our life the most difficult thing to do is to make decisions, right? Because we always will have more than one option to do something, whatever it may be. After completing a plus two, if you want to learn something, like that, you will have ask is to make business. Remember, investment decision is one of the most crucial in investment decision. They take decision on how to utilize the fund available with them. When the business have fund with them, they will have 1,000 of things to solve with that fund. But which thing they should take first? And should they take every options before them? All these questions appear when they have to make an investment. Okay, remember, whatever can be putting in some other investment option. Let it be anything. Okay, wherever it may be, when it comes to investment decision, it is difficult to make proper decision unless and you have enough study the options, study what is it wrong, what all things will happen, all these things kind of the financial it is the budgeting of capital. It gives where to spend what amount of capital or the fund collected by the business. See, now you can read here. Capital budgeting or investment decision is the process of evaluating and selecting long-term investment. Okay, remember it is a long-term investment always. Long-term investment or projects that involve substantial capital outlay. Capital outlay, in other words, can be said as cash outflow. Okay, capital outlay such as purchasing new machinery, building facilities, launching new projects, etc., etc. Whatever it may be, when we are investing, when we are keeping aside, or when we are putting our money for a long time at a certain place. So this chapter, capital budgeting, gives an idea about what are the basic aspects of investment decision, crucial thing, how to make a decision, what are the mathematical or financial to investment options. Okay, here listed some of the importance of capital budgeting. They are long-term decisions. Remember, the capital budgeting decisions are always made for a long term, so it is very important. It helps in maximizing the share value. If you remember, the objective of finance was either to maximize profit or maximize wealth. Long-term investment facilitates the maximization of wealth. Efficient resource allocation is important for a business. Risk assessment is happen here. Strategic planning is important. It helps in managing the cash flow. Yeah, competitive advantage lies on how brilliantly we take the investment decision. Also, we have to optimize our cost, right? Capital cost, because when we make an investment, it occurs a huge cost. So, it is very important to make right decision, unless our money will be lost in many different options. Now, what are the limitations we face? Always in business there is uncertainty and risk, because we are playing in the market, isn't it? Market own in each time. So we can't predict that market will go like this or go like that. There are always like uncertainty and risk in capital budgeting decision. Also, the main limitation is once you have decided that fund will be blocked, it will be committed for a long term. Think you brought a huge machinery, and afterwards, after buying it, you realize, oh, it was a wrong decision. What will happen? You can do nothing, because there you have to utilize that machine for a long time, or you have to sell it back for a loss. No company will do that. They will use it for a long time. So remember, every time it is a long term commitment of fund. Also, Have you heard of the word performance marketing? Today's marketing angles are completely changed. Today, the marketing is completely dependent on the performance of previous ads. When we are running an ad, when we are making a marketing campaign, the performance of it is very important to move forward. Similarly, whenever we are going to make a decision, we will search for past data, our past experience of making investment or past experience of some other companies making investment. We will make a deep study. We will make a deep study to find whether it was useful or whether they have made mistake by going this way. So you have to collect data, you have to make forecasting charts, you have to make go through many other complicated elements. So it is time consuming process, of course, but being an important thing, we can't ignore that. Moreover, when you see the following parts, you will see that we will have some sort of predicted future cash flows. That means when we are making investment in one project, they will predict, and they will invest, they will give us this much amount in coming years. But it is just prediction appropriate. How do they predict? How can they validate their prediction? It is very difficult. Also, non-financial factors are what ignored, like social issues that can come up, like labor strikes. All those things are ignored when we make financial analysis. In finance, we will only take into consideration things that can be measured in terms of money. Yeah, decision making biases are there. Bias is all what astray as why will take. For example, if you are a person who likes something, think you are from India, you love India very much, then while making decision between buying machines, you will give more importance to Indian companies unknowingly, because you love India, you want Indian companies to come up. If you have something like that in your mind, unfortunately, when you make a decision of buying a machinery, you will focus on Indian companies, even though better options are available abroad. This won't happen knowingly. Unknowingly you will do that is what. So there are chances of biases happening in decision making. Then it require cost of capital estimation. Yeah, we are told that inflation are different from what we can predict. Okay, limited availability of information. Yeah, that's another important thing. We make decision upon analyzing our past information. There is a potential for over investment. There happens where we make more than required investment in certain things. Okay, these all were the limitations of decision, or in other words, investment decisions. Now we can see what is the scope, what all areas are covered under this decision, what all means by capital budgeting or investment decision. It can be, okay, capital budgeting decision can be launching of a new business. See, when we launch a new business, we will have a commitment of long-term fund. You will have to choose between options, and you will have what the huge amount invested there. When we are replacing something, just think, you are running with some sort of machines and it has become outdated. You will be forced to replace it with something new, isn't it? When we make replacement also, we are making a capital budgeting or investment decision, because that involves huge amount of fund committed for a long term. Similarly, just think, we are going to expand our business. We are going to repeat whatever we are doing right now, but we are going to do it in more places. If your business was run just in Kerala, you are going to run it in other states also. This means you are expanding the volume of your business, isn't it? There also you will have to make huge investment committed for a long term. So where to invest, what to do, there also you will have to take proper decision. Similarly, diversification is another investment decision. Diversification means what? Think you are selling soaps in your market. Okay, if you are selling soap in your market, yes, you can sell many other things related, like shaving cream, toothpaste, or something, isn't it? You would have noticed companies like HUL, Hindustan Unilever are doing that. First of all, you will be doing some sort of business. Now you have entered some different options. Okay, here you are diversifying your business. There also you would have to take investment decision in which option to choose, where to invest, what quantity of amount to invest. Everything you have to decide. Also think you are going to make research R&D department. Okay, you must have heard of R&D department. It is research and development. Research is important and inevitable if you are going to make some change. See, everything, the first three things we are told before. If you are going to make a replacement, if you are going to expand your business, if you are going to diversify your business, it is quite impossible in the current marketing scenario without making proper research. So it is very sure that you will have to spend a lot of amount on research also. There also you will have to take decision which amount to, how much amount to be invested, what period of time should I invest. Everything pertains to your ability to access such thing from the past data. Also, the last important point, statutory are make more pollution. The law will force us to make bring something new there to replace that. So now we have seen what is the importance of capital budgeting, what are the limitations we have while we make capital budgeting decision or investment decision, and finally decision investment decision. Moving forward, we are going to see the methods. Okay, the methods of investment decision. What all methods are available to make investment decision? The methods available to make investment decisions are basically classified into two. It would be either traditional method or it will be what? It will be a modern method. Yeah, every traditional method will have a modern method. Traditional method is something that don't takes one basic concept into consideration called time value of money. Okay, now you just understand one thing. Traditional methods don't take time value of money into consideration, whereas modern methods take time value into money into consideration. Okay, now you should know what is time value of money. To make it simple, we can say time value of money is a concept in finance which states that the value of money goes down with passage of time. Okay, with passage of time, the value of money goes down. When time goes up, the value of money goes down. This concept needs some explanation, I will tell you. Just think, I am borrowing 100 rupees from you today. Okay, I am 100 rupees from you today, and after 1 year, I am just repaying that 100 rupees back to you. Okay, will you be happy receiving that 100 rupees after 1 year? Most probably you will say yes, because you know it will be received after 1 year and you have received the same. But unfortunately, in finance, we don't take it more happily. Why? Finance tries to understand the concept of what? Relationship between time and money. With the passage of time, the money also has some changes. Why this change is considered? As we told before, I have lent 100 rupees from you. Okay, just think, without, when I asked you, you didn't give me that 100 rupees. You said, no, I don't have my money, I will not give you anything. Without giving to me, you invested that somewhere, and after 1 year, you expect that investment to grow 10%. That means after 1 year, you will get 110 rupees. Okay, but without doing that investment, when you gave it to me, you got just 100 rupees after 1 year. So when you are lending that money to me, when you are giving that money to me, you are losing this 10 rupees profit, isn't it? The expectable profit over that. So finance have developed a procedure, they have developed a method to accompany, to consider, to take these loss into consideration whenever we are talking about future cash flows. This concept is called present value of money. Okay, now what is present value of money? Present value of the money is the amount equated to the future cash flow, equating the future cash flow to the current payment. I will give you an example. We can take the same thing. If you are taking 100 rupees and you expect this 100 rupees to earn 10% interest on 1 year, then what is the present value of this money? Present value means the amount that can be equal to you. If you receive this 100 rupee today, rather than getting it after 1 year. Just see, as we have told before, we will lose 10 rupees if you have lent it to me, and if you receive it after 1 year from me, isn't it? You will lose 10 rupees, because expecting this interest you would have earned rupees 110 rupees by the investment. So you are not investing here, you are lending that money to me. Okay, understanding this loss, you will calculate the present value of the money. Just take the present value of the money is 100 rupees minus the loss you expected, that is equal to 90 rupees. So now what does the present value means? Present value means that, okay, now you have lent this 100 rupees to me, and I told you, I said that I will give you back only after 1 year. Now you are giving me two options. Either I can pay after 1 year rupees 100 itself, or now I can pay him, that is today itself I can pay him 19 rupees instead of 100 rupees, because for you, okay, because you are a person who knows finance, you have considered the present value, you have considered the possible loss if you wait for 1 year. Now you are telling me, instead of paying this 100 rupees back as 100 rupees after 1 year, you can pay it now itself as 19 rupees, because for me, please note that, please listen to that, for me, a person who knows finance, the 100 rupees received after 1 year is equal to 19 rupees received today. Okay, because we have considered this loss. So understand, present value is the value of money that we take into consideration after looking into the possible losses we will have if there is a waiting period. So we are ignoring that waiting period. We are not ready to wait for that time. Why? Waiting makes our potential to lose. So instead of receiving it after a waiting period, okay, if instead of receiving our investment back after a waiting period, if we are receiving it today, what will be the value we expect it should have after considering this possible loss? That value is known as the present value of money. I know it is a complicated concept for people who don't know the basics of finance, but if you can listen this concept more than once, I am sure that you will understand. Yet if you can't understand, please let me know. I will explain it in a single video. Now, we have considered the present value of money. So I am going back to what we are talking before. The capital budgeting methods can be, or the investment decision method can be divided into two: traditional methods and modern methods. Modern methods consider the what present value of money, where, or in other terms, it can be told, modern methods consider the time value of money, whereas traditional method don't take that into consideration. So for traditional method, the amount we received today is equal to amount we received after 10 years. They don't have difference on passage of time. The time going up is not something that they take into consideration. The amount is same for them always, but modern method is not like that. Okay, so we will see what all are the traditional methods, what all are the modern methods we are going to see. We are going to see some of the traditional methods like pay back period and ARR method, and modern methods like NPV method, IRR method, and PA method. Okay, I'm just giving the short form. We will see it in detail. Here we are going to see the payback period and NPV, how to solve these questions, or how to take decisions on these methods deeply. We will just see what are the other methods. In this video, don't worry, we are not going to make a long decision. We are just going to see an introduction to these methods. We will discuss the other methods in another video. Now let's see what are the methods of capital budgeting. The same thing I have told you before. there is traditional method and modern method. Traditional method doesn't consider time value of money or the present value of money into consideration. The very first traditional method is ARR method. ARR method takes the average profit that we expect from a project and divided by the investment into 100. Okay, now just think the ARR is equal to 10 percentage. You got ARR 10 percentage. Then how can we make a decision? You should have an idea. You should have an idea on what percentage of ARR we should expect. ARR means average rate of return or accounting rate of return. Here we should have a basic idea on what thing I want 12 percentage return from a project. Just think I have this idea in my mind, but found that the project will only give 10 percentage return. What will I do? I will not accept that project. I will not let that project. Means it can be buying a machine, it can be doing something else, so it can be investing in a company, whatever it may be. I expect a 12 percentage return from there, but the average return they promise as per the calculation, when we divide the average annual profit expected with the initial investment we made, we got only 10 percentage. So does that mean I should take that investment option? No, I will not consider that investment option. I will keep checking the average rate of return of other methods till I get something equal to or about 12 percentage. This is how decision is made in ARR methods. Now the payback period method, very important thing. See, we will have an example. We'll see. Don't worry, we are not going to make any calculations here. Just we can have a look at here. See, here we are given with the project cost of X, project X and project Y, and they are given with what cash flow we can expect in the upcoming 5 years from each project. Here just think, project X means buying a mission called X, project Y means buying a mission called Y. So we have two options before us. We can either buy mission X or we can either buy mission Y. Now with the help of payback period method, we are going to make a decision on which mission we should buy. The name, as per the name, payback period denotes we give importance to the period taken to pay back. Okay, payback means to give us back. Okay, here we are considering the time taken for the business, so the investment, so the investment option to pay back our investment. Here we are going to invest 60,000 for both the project, but among this project we will select the project only that one thing which will repay this amount as soon as possible. So they have given how much years will they what all amount they will pay in the upcoming 5 years. The people who gave us this information don't know. We are going to consider PBP method here, payback period method here, or else they would have given such manipulated amounts. See, here we will look up into taking cumulative cash inflow. Cumulative means we will sum up the cash inflow they have given. First year project X told they will give 30,000 to us. Second year they told they will give 20,000 to us. So by the second year they would have paid us what? 50,000 rupees. Third year they will give another 10,000 rupees. So by the third year project X will give us 60,000 rupees. Yes, 60,000 was our investment. So we know by the third year project X will give us what? 60,000 rupees. Now we can look at what happens in project Y. First year they will give 10,000 rupees. Okay, second year they will give 20,000 rupees. That means by the second year they would have paid 30,000 rupees. By third year they will give another 30,000 rupees. That means again by third year we will get 60,000 rupees. This means that both project X and project Y will pay us 60,000 rupees. They will pay back our investment by the third year. This is one of the main limitation of the traditional method, payback period method. Here we can't choose between these two investments. If just imagine that the project X will pay back by third year and project Y will pay back at the fourth year alone. If it was something like that, we can select the third year. Why? Project X repays us as soon as possible. But here, since both the projects give us pay back the amount at the third year, we will have to move to another method like ARR method or something to make further decisions. Okay. Also there is one formula. I am not revealing this here. I don't want to discuss here. I don't want to make you confused. We will do it in the problem. Okay, here is another problem. It is just a little bit complicated. We will discuss in another video. Don't worry. So we have seen the major two traditional methods for decision making, investment decisions. Now we have three modern methods. Out of this, just one we will do in the upcoming video. Other two methods, let it be there, just know it. Okay, the three methods are net present value method, IRR method, and profitability index method. Net present value method, first method, it gives us an idea. It gives us what it takes us into the concept of discounted cash inflow. Discounted cash inflow means the sum of present value of cash inflow. Like what we have seen in the payback period method, the project, whenever the project makes a proposal, they will give an idea what amount they will repay to us in each upcoming years. Here we won't take the sum of the cash flow what they give, we will take the discounted. That means after considering the present value of money they promise us to pay in the upcoming years minus total investment, and that is called our net present value. Okay, so net present value is the difference between sum of present value of cash inflow minus the investment we make. It is our net present value. So when we have two or more projects before us, we will find the net present value of each project and we will select the project with the highest net present value. Here this is the basic criteria for selecting. If a project has, if we have just one project before us, we will check whether the project have an NPV equal to or greater than 0. That means it should have a positive NPV. If it has a positive NPV, we will select that. If it has a negative NPV, that means we are going to make loss by investing in that project. We will not select that project. Here is just another question. I am not going to discuss it deeper, but we can have an idea. We will have an idea on how to solve this problem. Here we are given with that investment. Okay, the investment we have to make in project X and project Y. They have made this proposal before us. They said that in the upcoming 3 years, this much amount will be paid. Project X will pay this much amount for 2 upcoming years. Project Y will pay these amounts in the upcoming years. Also, after this, we will have an idea on what percentage return we should expect. What we have in our mind is we should get a return of at least 8% from this investment. That means if we are not investing in this project, okay, if we are not investing in this project, we will invest in some safe places, some other safe places. It will of course give us 8% return. That is the idea what we have in our mind. So what we are going to do, we should make sure this investment will at least give us money equated to the present value, equated to 8% return we earn in future, or we should get more than that, unless taking this project is taking risk unnecessarily. So we can see how we will solve this problem. See, we will separately calculate the NPV of project X and project Y. We have the present value given in the question itself. We will multiply each present value with the cash flow of the corresponding year. So the person who made the proposal told us that after 1 year they will give 50,000 rupees, but we, being a person expecting at least 8% return from a safer investment, we said okay, the 50,000 rupees you agreed to pay after 1 year for us is 30,890 when we consider the present value. After 2 years they said they will pay 10,000 rupees, but being a person who takes this 8% return into consideration, okay, if you pay 10,000 after 2 years, when we look at from present, when we look at from today, for us it is just 8,570, because we are waiting for 2 long years, isn't it? So we are taking the losses we will make by that time into consideration. Similarly, we will go with the third year, and they agreed to pay a 30,000 rupees for the investment, but for us, because we consider the loss of money, the possible loss of money by waiting for this return, we take this 30,000 as only 26,430 rupees. So how to find NPV? NPV, as we told, is the difference between this amount and the 25,000 investment we made, that is 1,430 rupees. So after considering the time value, this is the profit we can expect from this project, 1,430 rupees. When it comes to project Y, they said they will pay 3,000 rupees after 1 year. We said, okay, we are waiting for 1 year, we expect at least 8% return. So that means the 3000 you pay after 1 year is just 2778 rupees as of now for us. Similarly, 7,000 they pay after 2 years. For us, it is 5,899 rupees. Similarly, it goes. Finally, we found that okay, they agreed to pay us 30,000 rupees, but after considering the time value of money, after considering the loss we will make by just waiting for them to make the repayment, the value of 30,000 is just 24,657,000. So when we deduct 25,000 from it, we make losses. We are bloody sure that if we invest in project Y and if we expect at least them to pay 8% return, we are going to make a loss in the long run. See, for a common man's eye, both the project looks same. Why? They are going to pay 30,000 rupees after 3 years. But when we consider the time value of money, see, project Y is paying a huge amount, that is 20,000 after 2 years. They are making us wait for a long time. So when we consider the time value of money, we understood that if we invest in project Y, we are going to make a loss. So project Y is rejected and project X is accepted. This is the idea behind the NPV. Don't worry, we will do this as a practical question. It is very important. So other methods are very related to NPV method itself. See, the other method is internal rate of return. Internal rate of return is the rate at which NPV equates 0. That means our cash inflow, the discounted cash inflow is equal to the discounted cash outflow. Something related to what? The break-even point. We will find the break-even point at which our income from the project is equated to the expense. Okay. So IRR is not finding the profit we make from a project. Instead, we are finding our discount rate. The discount rate at which our NPV will become 0. See, we had a discount rate here, it was 8%. We had an expectation on what is the minimum amount we should earn, isn't it? Similarly, here it was just an assumption, but here in IRR method we will find what is the discount rate. In the above question we said it is 8%, but here we will say what is the discount percentage that we should expect so that our NPV will become 0. Okay, what is the point of making our NPV 0? Just remember this, we had a selection criteria. We need a project that will give at least 0, isn't it? The project should have a positive return or else we will not accept it. So IRR method gives us the discount rate which makes our project's profit equal to 0. Now think we got the answer, we got the IRR as 10%. Then what is the next thing? We should check whether the project before us gives a return of more than 10%. If it gives more than 10% return, we can accept it, because we know if we are considering 10% as our selection criteria, our NPV will become 0. So if we are getting a return more than 10%, what does it mean? Our project will become profitable. So to get a better idea on that, we use IRR method. It is somewhat complicated than NPV method, but it is very significant. Similarly, we have profitability index method. Profitability index method makes a comparison. Make a comparison of the cost we incurred on making a project. Let it be buying an asset, investing somewhere, whatever it may be. It has a cost, isn't it? We are going to find the ratio of expected cash over the investment we have made. There also we will find a ratio. If we multiply this with 100, we will find a ratio, or else we will find a value between 0, sorry, not 0, we will find a value which is either above 1, which can be above 1, equal to 1, or below 1. Equal to 1 means what? If you know basic mathematics, you know if it is equal to 1 means the present value of cash inflow become equated to initial investment. That is, we are just receiving what we have invested. We are not receiving anything more. For some project it is okay, at least we are getting back our investment, right? But If you need an profit over your investment, what should you get? The profitability index should be above 1, that is greater than 1. Here also we are looking into the NPV itself. We are going to find the present value of cash inflow divided by present value of cash outflow. It is equal to sum of present value of cash inflow divided by present value of cash outflow. Remember, we often don't speak about present value of cash outflow because very often we make investment at current present date only. Present value for something we have done present is the same. We don't have to consider the time values in it. But in rare cases, they will have investment made over more than 1 year. In such situations, we will take consideration of the present value of our cash outflow also. Just leave it, I'm not making it complicated. Just understand, profitability index is a ratio. It finds the relationship between the money we will receive in future, the present value of money we will receive in future, and the investment that we are making today. So if the answer we get is less than 1, means we are going to make a loss through that project. If we get 1, means we are either going to make a loss nor going to make a profit. And if the answer is greater than 1, it means that the project looks profitable. So these are the methods of capital budgeting. We have seen what is capital budgeting, some aspects of capital budgeting and methods of capital budgeting. In the upcoming videos, we will see in detail how to make decisions on NPV method and how to make decision on payback period method. Hope the concept was clear for you. If you feel any doubt, please let me know. We can discuss it deeper. Thank you all.